So basically, they copy the World Bank, they copy the IMF. And I want to make 2 points. Number one, it's not like the BRICS popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They kind of run a show, very methodical. So they duplicated the World Bank. They duplicated the IMF. Now they have applicants for membership, and there are, I think, 21 or more countries who have applied. Well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted in August 22nd. That's the next big meeting, starting with Saudi Arabia. So what happens when you let Saudi Arabia into the BRICS, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have 2 of the 3 largest nuclear arsenals in the world, Russia and China. You have, throwing India in, and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global landmass. I could go on and on. My point is that I learned development economics in the 1970s. We had something called the third world. It was Russia or Soviet Union, the U.S., and then there was the third world. And all you knew about them was they were poor, and you had to get them off the runway. We actually had the runway theory of how you grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military. And again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the BRICS. There's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, the EEU was Putin's answer. And this has been around for a long time. This goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics. I'm not, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, or the SCO, led by China. And these are mostly Central Asian republics, including Kyrgyzstan and Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China. China's a member of 2. Russia's the only country in the world that's a member of all 3. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this new currency plays out, that those other countries will join in. When you do that, and I found a really cool widget. It's a map of the world that's blank, and you can go country by country and fill in by color. Just click on it and give it a color. And I did that. And I was like, oh, okay, here's the BRICS. It's 5 countries or whatever. Well, here are the applicants. It has another 20. Here's the SCO, a few more. Some of them are members of both. Here's the EEU. That's a few more. Again, many are members of both. And you keep going. And all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island. What he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is, more collective economic and population power? By the way, output of wheat, pick your metric, this dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Why? Let's just kind of digress for a second. And what are the headlines saying? Again, you correctly said, haven't we been talking about this for 10 years? Well, yeah, actually we have. But in the past year, what are the headlines? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-product currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have two countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? I mean, and Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Russia sells oil to China. China pays in Brics, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem. Mm-hmm. You've solved the problem of what to do with a pile of currency that you really can't use other than certain goods and services, but not everything you want. And there's an analyst who's brilliant. I read his stuff all the time. I'm like, man, you're so smart. And I just really follow him very, very closely and give him a lot of credit. But he came out a few days ago, maybe a week, and said he'd heard about this and he was kind of dismissing. He said, you can't have a currency union without a common fiscal policy. And I said, I don't want to mention his name, but I said, have you not heard of the euro? I mean, there is no common fiscal policy in Europe. Don't tell me that Italy has the same fiscal policy as the Netherlands or that Germany has the same fiscal policy as Greece. They don't. They do have a central bank that issues the currency, has a little bit of gold, but not a lot relative to the size of the economy. But there's no common fiscal policy and there's no common bond market. To this day, there's no such thing as a bond, I'll call it a Eurobond, backed by the full faith and credit of the entire European monetary zone. It doesn't exist. You can buy German bonds in euros. You can buy Italian bonds in euros, but you can't buy a Euro bond backed by all those countries. So they don't have a common bond market. And they don't have a common fiscal policy, but they do have a currency union that's very successful. They finally have the scale. They finally solved this problem, which I described, which kind of is not, when you got two countries, you're not too much further ahead than barter, but with 30 countries.
I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway. And there are a lot of reasons for that. Whenever I hear, fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1 worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, yeah, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques. And what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this bond bubble thing. The greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me -4%. That's a low real rate. You can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. It's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe -25, -50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about -7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards -1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity. the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next. And maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold.
Whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be, going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates. And if you're going to cut rates, buy stocks. That's Wall Street always ends every analysis with buy stocks. So here we see Wall Street in real time kind of bidding up tech stocks because the Fed's going to pivot and cut rates. When in fact, Powell's thinking, no, that's not happening until 2024. So that's what the Fed thinks is happening. The market thinks that Powell is over tightening, that inflation will come down faster, and the pivot will happen sooner. And that's why we've seen a little bit of a rally in stocks recently. So you have the Fed narrative, that's plan A. You have the market's version of what the Fed's actually doing, which is plan B. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it. but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. It's a triple, greatest bubble of all time, times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last, how are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? They're two different things. The global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves, and then they wake up to reality and they crash, correct down. But in terms of the global economy, I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States, or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies. But they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe, or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, the Fed will never do that. They will. They actually mean it. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their 3rd lost decade. The United States has had a lost decade from 2007. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes, you get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So the headwinds, demographic,
technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse.
The first point I would make is that global recessions are rare. Recessions in individual countries or economic communities like the EU do happen with some frequency, but a global recession is different. It's usually the case that even when a large group is in recession, somebody else is expanding. China, the 1970s used to call the U.S. the locomotive. If Germany was in recession, somehow the U.S. could kind of power through, although the U.S. itself had 3 recessions between 1974 and 1982. But a world recession is rare. We had one around the time of the 2008 financial crisis, even though Australia did power through it, okay, and certainly in 2020 during the pandemic lockdowns, but they're unusual. As I say, it's usually one group is in a little bit of trouble, but another group powers through and even can pull the recession country or group out of difficulty. But when global GDP declines, that's rare. We are heading for exactly that. To understand that, let's take a look at some of the largest economic groupings, and I'll start with the United States. Now, the United States had a mild recession in the first half of 2022. If you blinked, you missed it. First quarter GDP was negative, not a lot, about 1.6%. Second quarter GDP was also negative, about 0.9%. So first half as a whole, we had negative GDP. The rule of thumb definition of a recession is 2 consecutive quarters of declining GDP. That's the rule of thumb. We had that. It's in the data. Having said that, it was mild, and third quarter GDP and fourth quarter bounced back. But if there was a recession, it was mild. What I'm talking about is a much more severe recession, much more difficult, much sharper drop in economic output, beginning about now, with rising unemployment, slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but market has their own dynamic. They're saying, well, if the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned. Because as I say, the Fed's going to over-tighten. Now, why doesn't the Fed know this? Well, because they never know, because they have the worst forecasting record of any institution I can think of. Their entire history since 1913 is one blunder after another. And this will just be the latest in a long series. And so just to kind of summarize, the Fed's on a course. We know exactly what it is because they told us. All you have to do is listen to them and believe them. They're going to raise rates, let high rates do its work, do their work, and see the inflation come down, and maybe in 2024 cut rates. What I expect is they are going to raise rates for the next couple of meetings, exactly as I've described, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where a severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to finish on can't call it a happy note, but global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like your liquidity crisis? No. A recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, a recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, this is off balance sheet. You got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with the Q word, 1 quadrillion is 1,000 trillion. So I just said the Fed printed $9 trillion. Maybe it's down to $7 trillion. Yeah. But you have 1,000 trillion dollars of derivatives. And they have to be supported with collateral. Not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year Treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge. It's by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want Treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the U.S. dollar is so strong. People go, wait a second. The U.S. has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets. What's driving the demand for dollars is the need to get dollars to buy dollar-denominated collateral, specifically Treasury bills, to post as collateral to support the $1 quadrillion of derivatives. And that's going to persist until the system crashes, which it's in the process of doing. We got through 1998, we got through the dot-com crash, we got through 2008, we got through 2020 and COVID. There's actually a good size market drawdown in 2018 between October 1st, 2018 and Christmas Eve, what I call the Christmas Eve massacre. Stock markets dropped 20% in under 3 months when the Fed kept raising interest rates, even though the economy was weakening. So they have seen those, but every single time it came back, even in COVID, March, April 2020, the stock market went down 30%. It did. I mean, just almost straight down. But by September, we were back to new all-time highs. And so it's not that they've never seen that kind of volatility, but they learned the wrong lesson, which is it always comes back. And we know why, because the Fed bails you out. The Fed floods the zone with money. The Fed talks it up, et cetera. But the counterexample, in 1929, when the stock market did crash, it was down 23% over 2 days. It was like 12% day, and an 11% day in late October 1929. But it kept going. The stock market crashed in October 1929, but it bottomed in June 1932. That was a 3-year moving crash or rolling crash, whatever you want to call it, with some rallies along the way. And the total damage was over 80%, not 30%, not 40%, down 80%. And what people don't know, many people don't know, is you said, okay, then it rallied in 1933 and 1934. The Fed messed up again and blundered again, as they usually do, in 1937 and threw us into a double dip. But if you ask people, okay, well, everyone knows the stock market crashed in 1929. When did it regain those highs? How long did that take? The answer is 25 years. It was 1954 before the market recovered from 1929. Now, it doesn't mean there weren't gains along the way or you couldn't make money. You could. But if you say, oh, I'll just sit tight and wait till it comes back, well, a lot of people didn't live long enough. They never saw their money back because they didn't live 25 more years. So that's a real bear market. It's happened before. The point is you need to be prepared for things like that. And no one alive, but very few people alive have seen anything like that. And if you say, well, what if we had another market crash right now? We'll talk about reasons why in a second. Why couldn't the Fed just come right back in and, print some more money and do the same thing over again and bail out the new failures, whoever they may be? You can just kind of keep bailing things out. Why not do it again? What's the big deal? Well, the answer is each bailout is bigger than the one before. And that's the point. You can go all the way back, 1994, Mexico, 1998, Russia, LTCM, 2000, dot-com, 2008, Lehman, 2020, pandemic. And they do bail out, but each one's bigger than the one before. I mean, we threw out $6 or $7 trillion of new debt on top of a $1 trillion a year baseline, $7 trillion in new debt to kind of dig our way out of 2020. So there is a limit. There comes a time it's like, hey, this bailout is going to be 20 trillion. Sorry, that check's too big. We're going to have to let some things fail. So what could happen? The first thing on my list is we're heading for a very severe recession. I just want to kind of explain briefly the dynamics of that. So the Fed's raising interest rates. We know that. They started, so it wasn't that long ago, but March 1st, 2022, the Fed policy rate was zero. It was 0%. People remember Paul Volcker. Oh, Paul Volcker raised interest rates to 20%. Well, he did, but so far Powell hasn't raised them as high, but he's raised them fast. I mean, even when Volcker was working his way to 20%, it took 3 years from 1979 to 1982. So Powell's plan is clear because he's told us. He said inflation is job one. It's not that we don't care, but unemployment is going to go up. We're going to have a recession. He doesn't use the R word, by the way, but it's implicit in everything he says. We are going to have a recession. Unemployment is going up. And too bad. It's kind of too bad because we got to get inflation under control. And so the Fed is in search of something that they call the terminal rate. What's the terminal rate? The terminal rate is a rate that's high enough to bring inflation down on its own without further hikes. So it doesn't have to be higher than inflation. It has to be high enough to cause inflation to come down to the Fed's goal of 2% without hiking more. And when they get there to that terminal rate, they'll sit tight. They call it the pause. And the pause could be a year. And Powell said this. Again, this is right out of his script. So Powell's in search of the terminal rate. By the way, if you said to me, hey, Jim, what's the terminal rate? I would answer truthfully. I would say, I don't know. But neither does Jay Powell. Jay Powell doesn't know what the terminal rate is. He's kind of saying, we'll know it when we see it, but we're not there yet, and we're going to keep going. And they have what they call the DOTS, silly name, but the members of the Board of Governors and the Federal Reserve Bank presidents give estimates, or their estimates of unemployment, inflation, growth, and interest rates for the next 3 years. And they put them as dots on a chart, so they call it the dots. And then, Wall Street gets the dots. They do a central tendency and regressions and all this stuff. One of the top Fed insiders, practically sits in Jay Powell's lap and has all the way back to Bernanke and Yellen, told me personally, he said, inside the Fed, they regard the dots as a joke. They're not better than guesses. Their forecasting ability is dismal. You or I would have better forecasts. And they wish they could get out of it, but they don't know how. So that's the truth. But the problem is, Wall Street and the financial media and the talking heads on CNBC, they want to talk about the dots, and it does affect market behavior. So even though it's a joke, even though the forecasts are terrible, you have to pay attention because it affects the markets. And if you're affecting the markets, you're on the wrong side, you're going to get run over. So I look at the dots, not because I put weight on them as predictive analytic tools, but because the market pays attention. So we have to pay attention. So the dots say that the terminal rate is going to be approximately 5.1%. They're not going to have a 0.1%. So 5.25 is your best guess as to what the Fed thinks the terminal rate is, because that's what they said in the dots. The market says, hey, inflation is already coming down. And so the market says, hey, you did it. You're already there. Inflation is coming down. Why don't you stop? And by the way, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down. And then you're going to cut rates. This is the famous pivot. Whenever you hear of the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow, but it won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out. The Fed's going to cut rates, but so buy stocks. That's all Wall Street knows is buy stocks. But the conundrum is inflation coming down because the Fed is still hiking? Or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking and I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. That means, as usual, they're going to screw it up. They're going to blunder. They're going to go too far. And it's not going to be a mild recession. It's not going to be Goldilocks. In this version, Goldilocks gets eaten by the bears. In other words, you're going to throw this economy into a very deep recession because you're going to go too far, as usual. And you're not going to know it until too late. By the time you realize it's mission accomplished, you will have gone too far, too long, rates are going to be too high, and it's not going to be a soft landing. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, but Powell's going to stick to his guns and raise rates too high, that's going to cause stocks to crash very severely, very suddenly. If the market were adjusting, say, yeah, Powell means it, it's going to keep, we ought to come down a little bit, that would be one thing, but that's not what's happening. The market's trying to rally. Powell's warning people what's going to happen. They're not listening, and it is going to happen. Everything I just described is playing out, and there's data to back it up, not just an inverted Treasury yield curve, which is interesting. Well, T+10 is the main sector where it's inverted, but even more profoundly in the Eurodollar futures curve. Yeah, I call the Treasury yield curve a short-term bet on a long-term rate. The Eurodollar futures curve is a long-term bet on a short-term rate, because the Eurodollar future is like we're betting on what an overnight rate is going to be 2 years from now. So, okay, long-term bet on a short-term rate, and it's inverted, and it shouldn't be inverted. That should never, it does happen, but it should not happen. Yield curve should be upward sloping just because time value of money and uncertainty, et cetera. If I lend to for a longer period of time or make a further forward bet, I should get a higher rate. Well, how come people betting on overnight rates a year or 2 years from now think that rates are going to be lower? And that shouldn't happen. The only explanation for that is we're going to go into recession. It's going to get a lot worse. But going back to a really important distinction between a recession, even a bad one, and a financial crisis, because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis, and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown and, turning on CNBC and like watching pets.com, the sock puppet, and all these things. They're going to the moon. Like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized in, they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% in annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession, but that's just what happens when you shut down the economy. But there was not a financial panic. Stock market fell, but the banks didn't fail. Nobody's lined up to take the money out of Citibank, et cetera. So you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day. No recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG, but I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about is we may be heading into both. For everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off. Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic, and a likely recession. We could very well be looking at a severe recession and a global liquidity crisis, two different things, but they could converge. Got to give a little credit to Robert Shiller. He wrote a great book called Narrative Economics. Now, narrative is just a fancy word for a story. It's like, okay, you can call it a narrative, and it means a lot of people buy into it, but it just means there's a story that people believe. And this goes back to the greatest sociologist of the 20th century, Robert K. Merton. There is no Nobel Prize in sociology, but if there were, Robert K. Merton would have won it. But he's the one who came up with the phrase, the self-fulfilling prophecy. And the classic case is you wake up in the morning, the bank's fine, but somebody gets nervous and they run down and take all their money out. And somebody sees them and go, what are you doing? So I'm getting my money out of this bank. Okay, I better get my money out too. And everyone's like, I don't want to be the last one out. Next thing you know, there's a line around the block. And by the end of the day, the bank shuts its doors and they're bankrupt. But they weren't bankrupt at 9 o'clock in the morning. It's because a story spread. People believed it. People acted on it. And that's the key. Do you act on the story? You can make the thing you're worried about come true, even though it wasn't true when the story started. Narratives can be true, but they can be false. In other words, a completely false narrative can be extremely powerful if enough people buy into it. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in fall, late 2021. November 2021, Jay Powell says, time to retire the word transitory. And then inflation goes to the roof. The stock market goes down. It's still going down. But then after the Fed raised rates, and then the yield curve's inverted, the narrative's like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower months from now. Inflation's cooling off a little bit, and it has. And so they're going to have to cut rates. That was the pivot. And rate cuts are good for stocks, so buy stocks. But then we get this rally, and the stock market's, we're covering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. You don't want to stand in front of a moving train. I wasn't going to short the S&P. I did not buy into the narrative. I said for two reasons. Number one, inflation came down from 9. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, it doesn't mean the Fed's going to cut. That is the message. But it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. The buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. But the fundamentals have not changed. Forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DV01, which is the dollar value of 1 basis point. And what it means is if interest rates go up, 25 basis points, what's the change in the price of securities? In other words, what's the the rates up, prices down, rates down, prices up. That's just bond math, but it's not uniform or linear at all levels of rates. So when you at higher rates, the DV01 is lower, and at lower rates, the DV01 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. A much higher interest rate is a whole different world, but the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar, and that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DV01, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. That's definitely cause for concern. It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no. If you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity on the 10-year note goes down, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States, in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan, or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed.
But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it took about 75 years. So it began in 1914. 1914 was the outbreak of World War One. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War's not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets. And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, no, seriously, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold it an ounce since 1980.
Everything I just described is playing out, and there's data to back it up, not just an inverted Treasury yield curve, which is interesting. Well, 2 to 10 is the main sector where it's inverted, but even more profoundly in the Eurodollar futures curve. Yeah, I call the Treasury yield curve a short-term bet on a long-term rate. The Eurodollar futures curve is a long-term bet on a short-term rate, because the Eurodollar future it's like we're betting on what an overnight rate is going to be 2 years from now. So, okay, long-term bet on a short-term rate, and it's inverted, and it shouldn't be inverted. That should never, it does happen, but it should not happen. Yield curve should be upward sloping just because time value of money and uncertainty, et cetera. If I lend to you for a longer period of time or make a further forward bet, I should get a higher rate. Well, how come people betting on overnight rates a year or 2 years from now think that rates are going to be lower? And that shouldn't happen. The only explanation for that is we're going to go into recession. It's going to get a lot worse. But going back to a really important distinction between a recession, even a bad one, and a financial crisis, because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis, and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown, and turning on CNBC and like watching pets.com, the sock puppet, and all these things. They're going to the moon. Like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized. And they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% in annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession, but that's just what happens when you shut down the economy. But there was not a financial panic. Stock market fell, but the banks didn't fail. Nobody's lined up to take the money out of Citibank, et cetera. So you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day, no recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG. But I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about is we may be heading into both. If everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off. Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic, and a likely recession. We could very well be looking at a severe recession and a global liquidity crisis, 2 different things, but they could converge. Got to give a little credit to Robert Shiller. He wrote a great book called Narrative Economics. Now, narrative is just a fancy word for a story. It's like, okay, you can call it a narrative, and it means a lot of people buy into it, but it just means there's a story that people believe. And this goes back to the greatest sociologist of the 20th century, Robert K. Merton. There is no Nobel Prize in sociology, but if there were, Robert K. Merton would have won it. But he's the one who came up with the phrase, the self-fulfilling prophecy. And the classic case is you wake up in the morning, the bank's fine, but somebody gets nervous and they run down and take all their money out. And somebody sees them and go, what are you doing? I say, I'm getting my money out of this bank. Okay, I better get my money out too. And everyone's like, I don't want to be the last one out. Next thing you know, there's a line around the block. And by the end of the day, the bank shuts its doors and they're bankrupt. But they weren't bankrupt at 9 o'clock in the morning. It's because a story spread. People believed it. People acted on it. And that's the key. Do you act on the story? You can make the thing you're worried about come true, even though it wasn't true when the story started. Narratives can be true, but they can be false. In other words, a completely false narrative can be extremely powerful if enough people buy into it. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in late 2021. November 2021, Jay Powell says, time to retire the word transitory. And then inflation goes to the roof. The stock market goes down. It's still going down. But then after the Fed raised rates, and then the yield curve is inverted, the narrative is like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower months from now. Inflation's cooling off a little bit, and it has. And so they're going to have to cut rates. That was the pivot. And rate cuts are good for stocks, so buy stocks. But then we get this rally, and the stock market's, we're covering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P. I did not buy into the narrative. I said for two reasons. Number one, inflation came down from 9. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, it doesn't mean the Fed's going to cut. That is the message. But it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. The buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. But the fundamentals have not changed. Forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DBO1, which is the dollar value of 1 basis point. And what it means is if interest rates go up, 25 basis points, what's the change in the price of securities? In other words, what's the rates up, prices down, rates down, prices up. That's just bond math, but it's not uniform or linear at all levels of rates. So when at higher rates, the DBO1 is lower, and at lower rates, the DBO1 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. Much higher interest rates, a whole different world. But the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar. And that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DBO1, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. That's definitely cause for concern. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5 on the exact numbers. We haven't seen that level of unemployment, that low, that is, since the 1960s. And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? we had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah. So your real wage just went down. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years. It runs around 5% annualized, give or take. Sounds like, hey, 5% raise, what do you want? Well, yeah, but your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. First of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed. But you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. That's a depression level of unemployment. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is. And we can see it, but there's a reason for it. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off balance sheet. So they don't show up in, conventional ratios. You got to read the footnotes and they don't tell you that much. So, okay, what supports that? How do you get a 1 quadrillion dollar position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. That's what will drive the dollar higher. So they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, et cetera. The Fed will actually give you all the treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you treasury bills, and it's like, can be overnight, 1 week, whatever. And at some point you unwind it, but what you usually do is just roll it over. So a phone call to the Fed will get you all the treasury bills you want. So why doesn't that solve the problem? The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying treasury bills at auction because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you for basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage, and that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's treasury bills, give me a 4-week bill. That's going to drive the dollar higher against basically the euro. I write books and I also write several financial newsletters. So I'm thinking about topics all the time. And there's always one, usually you say, well, all right, this war in Ukraine is a really big deal. Got to cover that. Or financial implosion in China, really big deal. Got to cover that. Or what's going on in the U.S. and other topics. I could give you a long list, maybe the end of the dollar's role as a global reserve currency, et cetera. The difficulty now, they're all going on at once. Any one of those topics would, fill a newsletter or be a big topic, a heavy lift, but they're all going on at once. And number two, they're not unrelated. There are all kinds of correlations. The breakdown and collapse of the global supply chain, which preceded COVID. A lot of people say, well, COVID came along. Of course, it messed up the supply chain. In my new book, Sold Out, I've got very, very good documentation that shows the supply chain was breaking down before COVID. Now, of course, COVID made it worse. Yes. And the war in Ukraine made it worse yet. Yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, they're all a big deal. The war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. It's interesting because I do have, kind of an international following, but there are certain pockets. I mean, there are certain countries where, there's interest in what I do, or my books are published in that language, et cetera. So I have a good German following, and of course the Germans want to know what's going on with energy, and a Japanese following. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And I use, as recently as a few months ago, I would say, yeah, I think so. You can see it coming. And there's data. I never make statements like that without supporting it. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, and there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions. And they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's the greatest bubble of all time, real estate, stocks, and other asset classes. So, I do, that is my view, but it's shared by a number of other analysts. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82%. From top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So we're down. Nasdaq's down, bounced back a little bit, down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect. The soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. That's not priced into markets. The markets are pricing in a soft landing. They're not pricing in a really hard landing. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. We are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation, and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not. And the yield curves are not sloping, or upward sloping. They're inverted. They're going down. That tells you that, and we also see it's inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, yeah, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, I'm sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for that. So the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. But that's not priced into markets. The markets are kind of pricing in a squishy landing or soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get.